going to be going through several markets here just as a quick overview and reminder that I will be doing daily videos this week, even this Friday. Okay, so we'll have a lot of content coming. None of the teaching will be in this video here. I just want to go over the review of what has happened and what might be taking place next. Okay, so teachings will be Monday, Tuesday, Wednesday, Thursday, and Friday. All right, so here is the dollar daily chart, and you can see the dollar has vaulted up through several of our premium arrays. This was the last one I gave you on the Wednesday review, and this is what we're looking for next. This is the volume imbalance on the daily chart. So it may be wanting to trade up into that. Now, I'm not convinced yet that we're going to take out this high. Okay, so I don't want any misunderstandings here. This, to me, looks like them pushing in a lot of premium that may lead to a later slide. It may be them just pumping it up, getting back up into this area here for a premium, keeping this high intact, and then working lower as a later price swing. We spent a lot of time down in here, so anyone that was trailing short positions on dollar, this smoked them. So I'm of the opinion, unless we take out this high, I'm still long-term bearish dollar. Okay, I have not changed my mind of that. Everything has happened so far like I've been looking for. They're informing us that the crops are not going to have enough water. The states are telling them, in different states, all the farmers rather, saying that they can't use the typical amount of water to plant, and that is not going to be a bearish thing for crops like corn, soybeans, wheat, and things like that. It's going to be impactful. Okay, what's occurring is they're trying to lock in these high prices. The farmers that do have crops, they want to have these prices in place right now. That causes, as you'll see later in this video, the decline, which is really attributed to supply and demand when it comes to commodities, because they are real markets. They're not fiat currency, they're not crypto, they're not metals that are highly manipulated. The world's grocery store, like corn, wheat, soybeans, cocoa, coffee, all those things, they have a real supply and demand factor. So those markets really do have influences put upon them through supply and demand. Because prices have moved so high in commodities, anyone that's producing it, think about it, if you were a grower or farmer for corn and wheat and soybeans, wouldn't you want to lock these prices in? That way you're going to get a healthy profit for what your crop may yield for you, because the coming months and year isn't going to permit them to make that much money. So they're trying to do a lot of basically hedging in these high prices for their crops. That in turn will cause this dollar rally. Now, you're going to see this and they're going to say, well, they're talking about raising interest rates in the next year or later in time. That's not the reason this is going on. Okay, this is all attributed to the commodity market locking in at really high prices, so that way those commodity producers can get those prices for their crops. Okay, I'm not bearish on corn, I'm not bearish on soybeans, I'm not bearish on any of those markets. Okay, they're likely to pull back, and I mentioned this weeks and months ago when we were last touching on them, and I'll bring up charts with it in this video here. I don't want to try to be too long-winded with it, but I just want to kind of like, from a macro standpoint, this doesn't change anything for me. This makes perfect sense to me because all of the commodity producers are trying to lock in those prices. That's going to do what? If they're selling futures contracts on the marketplace, they're making their crops available. If they're working inside those commodity markets, they're going to have a major impact on their prices, and they're going to decline as a result of that. That in turn is going to be a teeter-totter effect for dollar. So if commodity prices are selling off because there's going to be a gluttony of interest for selling their futures on the market, they're selling their futures in corn, soybeans. They're not selling it because they don't think it's going to go higher. They just need to do it now because think about it. They have to work within these commodity delivery months. It's not an every week, every day scenario. The commodity markets contracts, they expire. So they want to lock in those prices. That's all I see here. I have not seen anything here to turn the tide long term for dollar. I would concede if this high is taken out and it keeps on pressing higher. Yeah, then I'm probably wrong. I don't change my outlook on what's going to come in the coming months and into next year, because that absolutely is coming. Everything about water, the engineered drought, the engineered we don't have enough water to plant crops, and they're telling, don't take my word for it, go into these articles and research real farmers, real agricultural producers. And they're telling you that the government's saying they can't do this, they can't do that, they will not be permitted to use sufficient amount of water. Well, crops need water, folks, and if it's not raining and they can't use it from the municipal water supplies, well, what are they forced to do? They can't plant as much. So this is going to be extremely bullish for commodities going forward. But every market has to have a retrace. Every market, like a commodity market, corn, soybeans, and all that, when they're extremely high and you have these factors in play, you want to make sure you can get the highest possible prices during the delivery contract months that your crop would come to the marketplace. So when big commercial users like General Mills or Kellogg's are looking to buy their corn, you have made your corn available to the commodity market as a producer. So that way they're buying that contract at that high price because they need to buy it. They have to make cornflakes. They have to make cereals. Well, you as a commodity producer making corn and growing it, you want to make sure that you're getting that price. When your crop comes to delivery, you're getting paid that much because you have sold that contract price at the high prices. And the other side, a commercial entity like Kellogg's or General Mills in the U.S., they are buying that at the high price. Not because they're stupid and they think buying it at a high price is a smart thing to do. They have to have that commodity. Kellogg's can't simply go out of business because they didn't buy their corn. They have to have it, and they're going to buy it at a high price. And you're seeing the effects of that major move by the producers and growers, the farmers. They're trying to get their money right now. Why? Because they know they're not going to be able to do it in the coming months and into next year. Everything I've been warning you about, that's what's likely to unfold, and they're seeing all of their actions, if you will, in the marketplace fuel what we're seeing here. So if the commodity markets are seeing a huge influx of selling, not because it's topping the market, but because there's a lot of supply hitting the marketplace because they want to make sure they get their price. I do not think for a minute that the commodity markets have stopped going up. We're just seeing a correction. That would show this as a mirror image going up in dollar. We have a volume imbalance here. It could trade really up into that, not even completely fill it. In fact, if you pull up the fib from high to low, and I extend it out here so you can see, here is your 62 and 79% retracement levels respectively. And we have already moved into optimal trade entry. It makes sense for it to go up into this volume imbalance, but notice where the 79% retracement level is right there. I'm not saying it can't spike through and rebalance that and then ultimately try to work towards going lower on the dollar. But that's what I'm thinking ultimately, that we're not going to take this high out. This is just building in a premium. Everybody thinks the dollar has made the low. There's nothing suggesting that the dollar has made a low. There's nothing bullish about our U.S. currency. There's nothing bullish about our economy. It is not good. Okay, it's not good. I'm not trying to push a narrative. I'm not trying to arm wrestle because I think, this has gone against me and I'm trying to save face. I'm telling you, the underlying fundamental factors have not changed. They have increased in their intensity, if you will, of all the things that I've been telling you that is likely to occur. Do not fall victim to something like this and think that, okay, well, all that stuff isn't true now because look what's happening now. The dollar's going to scream higher. Michael's probably wrong, and therefore the economy isn't that bad and I shouldn't be preparing. Don't think that for a moment, folks. Please don't fall victim to that. Hourly chart, dollar index. You can see we had our buy side liquidity pool and sell side liquidity pool trading back down into that smaller fair value gap on the daily chart, which is these levels in here. And then a dramatic repricing, support inside of the next fair value gap on the daily chart. That's what we're seeing in here, optimal trade entry. And here is that volume imbalance. So we're looking for the likelihood of it trading up into that this week, and how we trade into this level and how we react once we get in there will be indicative of what I'm suggesting may be a continuation on the dollar lower. If it's true, if what I'm thinking is true, they're not going to want to waste a lot of time once it gets up in here. They should reprice aggressively lower, and all of this stuff here should be faded. That's what I would expect. I don't think it's going up here and then a gradual go slower down. I don't think that's what's in the cards. That's not what would be the likely scenario in my mind. I think that it's driving up here to get everyone short, because I think there's going to be some big moves coming on the upside on grains and commodities. And that means it's lower prices on dollar. Here's that lower level fair value gap on the daily chart. You can see it worked inside that. And we're consolidating in here. So we'll see if it once again run up into that into this week. All right, here's the euro dollar, the daily chart in here. I mentioned last week, without going in through all that again, we had consolidation inside that fair value gap here, filled in a small little fair value gap here, which is the opposite mirror image of what we showed on the dollar index, and repriced lower, working into here, and then ultimately crushed that, went through sell side liquidity. I gave you this one here as the next draw on liquidity. It went through that, and then now we're into this one here. If I'm wrong, okay, say they want to do a really, really aggressive run on dollar higher, and commodities get really smoked on the downside, really smash them down low. That would scare people from wanting to buy commodities. It still would not scare me. I'm looking at the fundamentals here, and in commodity markets, fundamentals are the absolute gospel. You have to know what's going on from a macro standpoint, and I'm telling you folks, all you have to do is take a step back and look at it. Just look at what's going on in the U.S. agricultural markets. Farmers, it's reported everywhere. They are not going to be able to plant as much. That's almost a guarantee that soybeans, corn, and wheat and all these markets are going to be going vertical. Not tomorrow, not this Wednesday or Thursday. It just means that over a long-term period, months into a year, that's the likelihood for those markets. And if they're going to go higher, dollar can't rally in those instances. It's going to be weaker. But let's say I'm wrong, and it's not as limited in terms of its pullback. If we do take out this low, we do have these relative equal lows here. And that would be an aggressive run on dollar shorts. And this would clear all of the longs out of euro. And again, nobody would want to buy it. If it did that, it would scare everybody from wanting to buy euro and not wanting to sell short on dollar. If that happens, and if we trade down into here, I'm going to be really interested in going short dollar and long foreign currency, because everybody's been cleared out of the marketplace. But right in here, we're going to be watching that going into this week. We have a small little fair value gap. Be mindful of that as well. It couples with these last two down close candles, which are in fact a bullish order block. If we do trade up higher, this area in here, which is an imbalance, watch that one. We don't necessarily need to go all the way back up into here. We can revisit the top end of this premium high of that fair value gap, and would be consequent encroachment of this high also. So if we say we bounce here, run up into here, we might see continuation going back down in. That could be a possible scenario to watch for this week. Hourly chart, fair value gap in here, worked off that, optimal trade entry, smoked all of the discount levels that would have been considered, which is extremely impressive here. And we have optimal trade entries in here, back into a bearish order block there, discount low, the fair value gap, traded down into this fair value gap's premium high. So we'll be watching again to see if it wants to roll over into that area. 15-minute time frame, you can see the respect of these fair value gap levels. Nice little fair value gap fill in there. Consolidation, breaks lower, optimal trade entry, another optimal trade entry, works the discount low of that fair value gap, and then breaks lower, goes to the next level of imbalance right in here. Now, this could pop up, take some buy side liquidity out, small little fair value gap there with mitigation block. So watch that with this small little fair value gap in there with buy side liquidity. It could drive up into that and then work towards that level there as a possible scenario. Moving on into cable. This one here, I mentioned if we traded down into here, that would be okay. It wouldn't really mess up market structure. This one here, to me, is more likely to take out this because, well, it's typical cable. Cable's going to do whatever you don't think it's going to do. So I think that if we get back up into this area here without going below the sell side liquidity, if we run back up and get back into like 139.50-ish, that would be institutional order flow entry drill and balanced price range. You see that? We have one single pass here with this candle defined by this low and this candle's high. This candle's low and this candle's high, so we have a balanced price range. If it trades back up to this candle's high or touches 39.50, that to me, I'd be interested in seeing that if we haven't already taken out this. That would be a nice scenario for me to think that we'd run right back over top of this and attack that. And I'm watching cable to see if this is what in fact unfolds, because if that is what we see here, then we are going to go for that higher high on dollar and that lower low on euro dollar. So it's kind of like watching this market to figure out which scenario is going to pan out. All right, you see the pound versus the dollar. Nice break lower in here. Worked inside of the fair value gap. Optimal trade entry right off of the discount low of the fair value gap relative to its daily chart. All I'm doing is taking those daily levels, transposing them down to the lower time frame hourly chart here. Market traded lower, back up into a mitigation block. It's the high, low, lower high. It breaks it. So this is not a breaker. It's mitigation. So it trades up into that within balance and breaker. Lower prices down into our low here. So if we trade higher, watch this one right in here, this fair value gap right there. If we don't need to go all the way back up to 39.50 or that old high here, watch this one, okay? If we trade above it and then we break down below this fair value gap, I'd like to see that as a resistance level, and that would be a nice framework for me to go short, but it needs to go up here first and then break back down below it. And I'd treat that as a nice institutional resistance level. And on the 15-minute time frame, again, we're working off this old low where we've taken a very shallow run below sell side liquidity. That's what this level is, by the way. And we went a little bit lower here, so it could potentially drive up into, as I mentioned over here, we have a mitigation block. So we'll see if it's going to want to trade back up into that. Very small little fair value gap there with a little bit of buy side resting below that short-term high. So again, if we get above 38.65, look for potentially returning back to 39.50-ish up there. But otherwise, it could just simply go up into a shallow run and then resume going lower and attack the sell side liquidity. I'm more inclined to think that pound dollar will go lower first and sweep out its relative equal lows before euro would. All right, real quick, E-mini S&P. I'm watching this area in here. I think we'll probably draw down into that. We went above this high there and rejected this movement here. If we continue lower, we're watching this. If it breaks below this and comes back up into the discount low as resistance, then we'll be looking for a run below here. And then keep your eye over here on this gap. That right there is very, very enticing to me because we have it below an old low with low resistance liquidity run signatures here, higher low to the right. And the last time we spoke on S&P, don't recall. I'll have to take a look at my notes and we'll revisit it on Monday. So I'll add something additional teaching-wise and all this business in here. From the last time I spoke, I just don't recall off the top of my head. I don't have my notes in front of me, and I apologize. But I'll include some of that on Monday. But I'm looking for it to trade back down into this area here. It doesn't need completely closing in, but if it does, that to me is bearish. And this might be something that they want to clean up as well. But if we do trade below the fair value gap, say we do like a big smash through it on the beginning of the week, if we come back up into this low or consequent encroachment, I'm going to be looking for some kind of a sell-off there to potentially target these lows here. And if it can really get wildly bearish, watch it come back down into this area in here. Otherwise, if we take out Friday's high, we're resuming higher prices. But that's the filter for that. Bitcoin. Oh my goodness, he's talking about Bitcoin. I mentioned that we could potentially come back down to 20,000, and we have been melting here. Nice little fair value gap right in there with optimal trade entry. If you've been following on my community tab on my YouTube channel, I mentioned that 62 was about it for me. I didn't see anything higher than that. I was wrong and went a little bit above it, just not by much, but about 2,000 plus points, and then gave up the ghost. Fair value gap right there with the breaker. So we have two down close candles here. That's your breaker prior to this run up that takes out the high here and there. We can't factor this low as a breaker from here, here, and here. When it broke there, I'm looking here first. I'm not looking at that one. This one here is a break in market structure for me because it hit a level that I think is a target as an upside. Even though we did break this low here later on, I'm looking at this breaker, this fair value gap, and this optimal trade entry back into a premium market. Then it breaks lower again. Institutional order flow entry drill there, right above this candle's high, inside of mitigation. Drops lower. We have some sell side liquidity in here. I thought that we would trade below it on that day. If you were with me in charts live, I was actually telling my son, I said, we're going to probably try to drive below here. I was wrong there. And you're probably saying, why are you even sharing that? But I don't know this market that well, so I'm being honest with you. But it's consolidated in here. We've already ran back above short-term buy-sell liquidity. So if we do trade lower, okay, if we take out these lows in here, I think it'll want to spread its legs and run back down into this area here. And if it does get wildly bearish and, you know, a lot of delivery on the downside happens, 20,000 just looks like, hey, you know, why not go back to it? You know, if you're a long-term bull on this market, a lot of people would love to pick up more at 20. I personally wouldn't. I don't want to trade it, but to me, a lot of people want to be buying it back down there because if it comes back to that, they're thinking it's really, really dirt cheap, and that'd be great to buy it there and ride it to 100,000. I don't personally subscribe to that view, but I would not be a buyer of Bitcoin. Let's put it that way. If I was trading it, I wouldn't buy it. Gold. We had a sell side imbalance, buy side inefficiency in here. Traded up into that. All the bodies basically respecting that. Broke down a little bit. Trade lower. We have a small little fair value gap there, and then we have sell side liquidity there. So if we get that run higher high on the dollar index, okay, if it takes out that short-term high I said I didn't want to see it or I don't expect it to trade above, if I'm wrong there, then if it really starts to run higher on the dollar index, this is where they're going to clean up on gold. So there's a lot of liquidity here on a large fund level. So that might be what we're looking for. What would get me there, if we trade below this fair value gap, come back up and act as resistance, that would be a nice framework for me, but it needs to show a willingness to go below it. And it might still require some time to get down into that here because we had a nice consolidation in here. So just, you know, I'm not going to trade gold. I'm just offering it because I haven't touched on it in a while. You know, I traded gold in that paper trading account on TradingView, picking a little bit of a run. It moved up into a small little fair value gap. I took profits there. You know that's a short, and ultimately it worked out as a really beautiful entry. In hindsight, I didn't short it, but go back and look at that fair value gap that I was using as a objective on the gold market. I did a small little buy on, and really nice cascading lower in response to that higher dollar. Soybean market. With the dollar index running higher, we had a nice optimal trade entry here. If you look at a higher time frame chart, you'll see this is a bearish order block. It trades up into that. I'll let you look at your higher time frame charts to see what that is. The symbol, if you pull up ZS exclamation point on TradingView, you'll get the continuous contract. That's what's being shown here. And optimal trade entry there. Bearish order block. Right in that little tiny little imbalance there. Hits it. Lots of sell stops below here, and it could ultimately go a little bit deeper, and that'd be just fine. It wouldn't mean anything to me about an overall change in trend. Again, go back. You're a grower, a farmer of soybeans, and it's trading up at these price levels here. You know, you are going to want to lock in, and everybody in the farming community that grows these commodities, they're all scrambling to try to lock in their prices. All during a time when all the news, all the intel, the reports, the agricultural reports, are telling us that they're not going to have the resources to grow as much as they're normally growing. So that translates to they're trying to get as much as they can on the crops they have and expect thinner yields on these crops in the coming months and into the year. And corn, here's the monthly chart. I'm showing you the midpoint of this last up close candle. So that's mean threshold, bearish order block, trades into that handsomely there. Look at that run. Boom. I do not think that we're going to be back down here. Okay, I don't think that's happening. I think, again, all of this is just them trying to lock in decent prices for the crops they have right now. But long term, corn, soybeans, wheat, forget about it. There's absolutely nothing in the future that suggests these crops are going to have bumper yield. And if there's a lack of resources to be able to plant the normal amount of commodity, and they can't get the water, and they can't get the backing of the country saying, okay, yeah, we're going to help you, and you can have water to make sure you plant the normal amount of crops that you do, they're not going to be able to do that. So if you're having everything tell you that they are not going to be able to do that, and they're also being paid to turn their crops over into the ground too, that's still going on. So how does all those things factor into this being a high? It doesn't. It doesn't translate. Okay, so all of this is just them taking a look at where they're at from a value standpoint and from an economic standpoint. They need to make sure they can lock in these nice high prices on what they have. As price goes higher, if we do take out this high, which I think ultimately in long term, we're going to be above $10 a bushel on corn next year. Between now and into next year, I think we're going over $10 a bushel and probably $15 a bushel. If everything is happening like it appears to be, I wouldn't be surprised if corn's $20 a bushel. Like, it's crazy to think where these markets are going to go if what is likely panning out, it's frightening to see how much these markets are going to go up. In the daily chart in here, so we could see it attack these sell stops under here. That would be just fine. We had a gap in here, volume imbalance, trade up into that, and then we have a small little imbalance, which was an immediate rebalance there. So if we see corn drop lower, just watch this area in here. It's a paper trade. It's about $5,000 price move. I'm not suggesting that you do trade against this underlyingly bullish market, but if it does trade back down here, that would make perfect sense to upset anybody that's long corn long term and they're just rolling their contracts over to next month when it expires. All their stops are right in here. They don't want to lose all this. But it would make perfect sense for it to drop down in there to upset any continuation on the upside. All the long holders, they would completely be wiped out, and they'd probably be afraid to get back in, especially if they do it on 2 or 3 candles. That would spook everybody from wanting to buy corn. To me, that's exciting because that's exactly what I expect them to do. But ultimately, these markets into next year, stratosphere. Like, I don't even know how far they can go. I'm just saying that $10 is likely. It might even be way more than that. So that's going to be it, folks. I will touch base with you tomorrow in another video. Again, I will try to have it up before 4 o'clock my local time. Okay, so just keep that as a deadline each day. If I can get up sooner, I will, but I have to do a lot of copies of it, so just be mindful of that. And again, every day this week, Monday through Friday, there will be a video and a teaching. Until I talk to you then, be safe.